What happens to these 5 stocks in a market crash? I changed it due to flagging issue. When the stock market crashes, panic sets in, but not all stocks react the same way. Some tumble hard, others hold steady, and a few even rise when fear takes over. In this video, we'll break down what happens to 5 different types of stocks during a market crash. Growth stocks, dividend payers, blue chips, defensive stocks, and speculative plays. So you'll know which ones sink, which ones survive, and which might even thrive when everything else is falling. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding market crashes. A market crash is typically defined as a sudden, steep decline in stock prices across a broad range of assets, usually within a few days or weeks. Crashes are often triggered by unexpected economic shocks, rising interest rates, geopolitical conflicts, or systemic failures in the financial system. What makes them especially dangerous is not just the decline in prices, but the fear and panic that drives investors to sell off their holdings at any price. During a crash, liquidity dries up, volatility spikes, and investor psychology becomes the main force moving markets. Historically, major crashes like the Great Depression of 1929, Black Monday in 1987, the dot-com bubble in 2000, and the 2008 financial crisis all followed this pattern. To understand how different stocks behave, it's important to remember that not all sectors and companies are equally vulnerable. Some businesses collapse under pressure, while others emerge stronger because of their defensive nature. In this article, we'll analyze what happens to 5 different types of stocks: growth stocks, blue chip stocks, dividend stocks, defensive stocks, and speculative stocks when markets crash. By breaking them down individually, we'll see how they behave differently, what risks they carry, and whether they can provide stability when panic dominates financial markets. 2. Growth stocks in a crash. Growth stocks are companies that trade at high valuations because of their future potential rather than current profits. Think of technology companies, innovative startups, or businesses with disruptive products. During bull markets, growth stocks often skyrocket because investors are willing to pay premium prices for future earnings. However, in a market crash, these same stocks tend to be hit the hardest. Why? Because when fear sets in, investors suddenly demand safety and prefer companies that already have strong cash flows rather than those promising profits years down the road. Price-to-earnings ratios collapse, and highly leveraged growth companies often struggle to raise capital, which intensifies selling pressure. The dot-com bubble is the perfect example, where many high-flying internet companies lost more than 80% of their value. Even in recent crashes, growth stocks like Tesla, Netflix, or Shopify have seen massive declines during downturns. That said, the survivors often rebound the strongest once the market stabilizes. 3. Blue chip stocks in a crash. Blue chip stocks are the large, established companies with strong brand recognition and consistent earnings. Examples include Apple, Coca-Cola, Microsoft, and Johnson & Johnson. During a market crash, blue chips also fall, but usually not as dramatically as growth or speculative stocks. The reason is that these companies have long histories of surviving recessions, diversified revenue streams, and strong balance sheets that make investors confident they'll recover. For instance, during the 2008 financial crisis, blue chip stocks like Procter & Gamble or McDonald's declined far less than small speculative companies. Moreover, many institutional investors, such as pension funds and mutual funds, continue holding blue chips even during downturns, which stabilizes their prices compared to more volatile stocks. However, it's important to note that not all blue chips are immune. Financial giants like Lehman Brothers in 2008 show that even big names can collapse if their fundamentals are weak. 4. Dividend stocks in a crash. Dividend-paying stocks are particularly interesting in a crash because they provide income even when stock prices are falling. Investors view them as a partial hedge against volatility since they still generate cash flow through quarterly payouts. Utility companies, consumer staples, and real estate investment trusts often fall into this category. In a crash, dividend stocks may decline in price, but their steady income stream makes them attractive to conservative investors. However, Not all dividend stocks are safe. Companies under financial pressure may cut or suspend dividends, which usually causes their stock price to collapse even further. A good example was during the COVID-19 crash in 2020, when many airlines and retail companies suspended dividends to preserve cash. On the other hand, firms with strong free cash flow, like Coca-Cola or Johnson & Johnson, maintained dividends, making them investor favorites during turbulent times. In fact, some dividend aristocrats, companies that have raised dividends for decades, are often seen as safe havens in market turmoil. 5. Defensive stocks in a crash. Defensive stocks belong to industries that provide essential goods and services people can't live without, like food, healthcare, and utilities. Examples include Walmart, Pfizer, and Duke Energy. In a crash, defensive stocks generally hold up much better than the broader market, because demand for their products remains relatively stable regardless of economic conditions. Even when consumers cut spending, they still buy groceries, take medicines, and pay electricity bills. That's why defensive stocks are often considered recession-proof investments. During the 2008 crash, healthcare companies like Johnson & Johnson fell far less than the overall market, while consumer staples like Procter & Gamble maintained steady demand. The key advantage of defensive stocks is that they provide stability and can balance out a portfolio heavily weighted in more volatile sectors. However, they are not completely immune. Panic selling can drag them down temporarily, and during extreme liquidity crunches, even defensive names may see short-term declines. 6. Speculative stocks in a crash. Speculative stocks are the most dangerous to hold in a crash. These are typically small-cap companies, penny stocks, or businesses built on hype rather than strong fundamentals. In bull markets, speculative stocks can rise dramatically as investors chase the next big thing. But in a crash, they are usually the first to collapse and the last to recover. Because these companies often lack steady cash flows, carry high debt, and rely on external funding, investors abandon them quickly when risk tolerance disappears. Many speculative stocks never recover at all, leaving investors with heavy losses. For instance, during the 2000 dot-com crash, hundreds of internet startups went bankrupt and disappeared forever. Similarly, during COVID-19, many speculative biotech and electric vehicle startups soared initially, but later collapsed when investor enthusiasm faded. The lesson is clear. Speculative stocks can make millionaires in good times, but they destroy wealth rapidly in downturns. 7. Investor psychology and panic selling. Understanding how different stocks behave in a crash also requires analyzing investor psychology. During market crashes, fear and uncertainty dominate decision-making, often leading to panic selling. Even fundamentally strong companies see their stock prices fall simply because investors want to get out at any cost. This is why correlations between stocks increase dramatically during crashes. Everything falls together, at least initially. Over time, however, distinctions emerge between strong companies and weak ones. For example, in March 2020, nearly all stocks plunged, but within months, defensive, blue chip, and high-quality dividend stocks recovered much faster than speculative names. Investor sentiment plays a huge role in amplifying losses, and herd mentality often leads to overselling. For disciplined investors, crashes present an opportunity to buy strong stocks at discounted prices, but only if they have the patience and financial stability to ride out volatility. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.